So I know everyone's getting tired and antsy for happy hour, I think. But this is definitely one of the more exciting panels. We're going to talk about venture capital and startups and how they're shaping innovation. And what I'm going to do is ask each of the panelists to briefly introduce themselves. So provide your name and what your focus is for your firm. And why don't we start with Suman?
Hi everyone, thanks for joining. My name is Shuman Talukdar. I run a boutique seed state Silicon Valley fund focused on what I call capital efficient AI. I've been doing it since 2020, 30 portfolio companies. Enterprise value is about $1 billion. Best companies at about a Series D now. And been in the Bay Area about 25 years, various operating roles. Been coming to Opal now since I think 2021. It's always a great crowd, and happy to be part of this group.
Great, Dan?
My name is Dan Lichowski. I'm the CIO for Central European Family Office. My role is predominantly over the next few years reallocating a lot of our real estate holdings predominantly into North American frontier technology and other things. So really excited.
Tracy McWilliams, and I am an investor, and I invest in early stage companies, but I do a couple other things. For a family, I've invested in early stage companies, but I've also created a fund and early stage fund tokenized in the marketplace on a platform called Liquidity. And so we are investing in companies that are creating operational efficiencies in businesses, industry agnostic.
I'm Natalia Sokolova, single family office, Verdi family office. We're focused on early stage technology, primarily in the safety and security sector. We invest in companies, but we also invest our own technology. We create our own technologies, and we help other companies through our labs to incubate and to help them grow their technologies as well.
Hi everyone. My name is Amit Jain, and I'm a co-founder for Ashikha Global Family Office. We primarily invest into listed stocks and unlisted companies as well. We invest 10% of our overall portfolio to startup ecosystem. Till now, we have been based out of Mumbai, but now we are expanding our reach out of Mumbai and exploring options to invest across the world. That's what we have. Thank you.
Terrific. So very impressive group. I think I'll start the first question with Amit and just reverse the sequence here. So maybe you can share with the group, how you have innovated your investment approach to the startup ecosystem in the last 5 years. Like maybe you can share
honestly, that's a tough question to answer because investment, trust me, is a very boring job and very responsible at the same time, right? Because innovation requires a lot of new approaches. So I can answer you in a way that how we have changed our approach in the last 5 years in terms of investments, right? Because last 5 years we have learned one thing, that if I am based out of Mumbai or India, I cannot be only focused on Mumbai ecosystem or India ecosystem. We have to go out and find out suitable opportunities for our investments so that we can multiply our portfolio returns. That's what we learned. And we have changed in our mindset in terms of innovation. Earlier we used to only invest into Indian ecosystem. Now we are going beyond India and figuring out all the countries in the world. And in fact, I shared yesterday as well. I don't know how many of you have been here yesterday. We have changed the approach. We have changed the approach in a way that we are trying to identify the countries which has their core competence. For example, China has a core competence in manufacturing. So what we do, we are exploring a lot of startups in manufacturing from China. Because I know that economy support that manufacturing theme, and any startup which come out of China has a higher chance of success because the ecosystem supports that. For example, if I want to invest into tech, I'll come back to US because US is known for deep tech, health tech, or whatever we talk about. This entire ecosystem supports tech big time. So I'll take a startup ecosystem of tech from US. But on the contrary, I will not invest into any manufacturing startup of US because that economy doesn't support that ecosystem of manufacturing. It's a high real estate cost, it's a high manufacturing cost, high labor cost, right? So we are trying to identify and tag each economy in the world that what is the core competence and a core sector of that economy, and if we can invest in that core sector and make money out of it. That's what we're trying to learn. So that's innovation, and that's what we are learning and we're evolving. Thank you.
That's very fascinating that you're looking at the big economy first and then figuring out which sector to go after. But once you find out your sector, then what are the criteria that you use to select your companies?
So honestly, we typically follow four-step process. Of course, right economy, right sector, right founder, founder plus right business solution, and of course the fourth is right valuation of the company. If we got all three, the right company, right sector, right economy, but the valuation is not right, we'll not invest. We are a value investor and we don't want to take a risk on our money. So unless we feel a value composition of that company, where we feel the valuation is perfectly all right, it is in sync with our thought process, we invest, else we'll give it a pass. So very selective, and I'm not a VC. I don't have a compulsion to invest into a startup or on a private equity space. I'm a family office. If I don't park my money, I'll move the money to gold, I'll move the money to real estate, I'll move the money to equities or a listed equities because I have a choice. I'm not a private equity fund, right? So I keep rotating my choice depending what opportunities are getting in the market.
So when we move on to Natalia, so is your process similar to Amit's, or how would you describe your process?
No, our process is a little bit different from, I would say, there's not really being a traditional family office. We believe that we can provide the most impact through the expertise, and our expertise is in safety security space. We find the companies through two different approaches. One is we do a deep research on what's available in the market right now, what problems the world is facing with the school shootings, with a lot of securities, the shootings that you see all over America, sadly. What can be done to prevent those? And we try to fill in the gaps. So, and the way we fill in the gaps, okay, what kind of technology can be enhanced? What kind of technology can be added? What other solutions are there? And then we see what companies provide the solution. So that's one way I would do it. Another one, because we do a lot of real-time video streamings, we do compression, communication, collaboration platforms, law enforcement, military. Then we see, okay, who's in the space? Who's in a drone space? Who are the top players? And then we go to our network and say, okay, what are the technologies that you really like that can be paradigm shifting technologies? And it doesn't really as important if they had a prior success before. That's why we created labs inside our family office, because if we really like the projects and we believe that their TAM, total addressable market, is big enough and it has legs, then we can bring it into our incubator and not only help with the funding, but also help them to execute it and take it to the market.
Would you say all your investments are in startups, or what percentage?
Portfolio? In the Verda family office, we have about, I would say 60% in the early stage startups. So quite large number, yeah.
And do you worry about the concentration risk?
No, because we understand the industry. So we're very, very specific about, who we bring in the thing. Obviously, it's enough diversification between the portfolio companies we have. And also by combining the companies into one ecosystem, they kind of piggyback on each other and they support each other. So it's we like roll them up into different SPVs. So that actually helps us to increase the value proposition to investors and to the shareholders of those companies. We also utilize OTCQB sometimes as a stepping stone to list them to the major market exchange, which is a very different approach than other companies that do it. And it gives a much faster liquidity to the investors, to individual investors that come in, and also give the companies ability to get retail investors so that they're ready when they go public to the bigger market.
Wow, okay. Thank you. Tracy, you mentioned that you tokenized your fund. That is so fascinating. Can you please elaborate on that?
Yes, well, first of all, when I look at transactions, I look at the founders. To me, that is, I mean, I have my thesis, which is operational efficiencies, and that is my fund. Prior to establishing the fund, I've invested in a lot of founders. And pre-COVID, change in the market, pre-AI, I've invested in founders. And so what I have found is these founders that are exceptional are the ones that can pivot through difficult times. And this brings me to the tokenization. The platform that I tokenize our fund on is a platform called liquidity.io. And the reason I went with Liquidity is I have invested with this founder twice already, and they've had 2 exits in the financial services industry from very large institutions in a very short period of time. They're able to see the future of what's going on in the marketplace and where the trends are, and they just go in and really spend their time building something. And so they started this platform 5 years ago. So nobody was talking about tokenization. Nobody was talking about why it's important. We decided to tokenize our fund because we believe in operational efficiency. And tokenization is different than just investing in digital assets. It's actually the operational efficiency that's going to create operations, and that in large institutions. And large institutions now are 100% on board with tokenization because they realize they don't have a good track of ownership on all the assets they own. And so we have decided to go down this path. It creates liquidity, but it also creates operational efficiency. There are lockup periods, even in tokenization, and the regulatory environment has changed completely in the United States just this year. Prior to this year, banks couldn't even look at anything in the digital asset space, couldn't look at tokenization. And we believe that not only is financial services going to look completely different within 2 years, but the supply chain, IoT, and of course AI is wrapped up into all of these things. But we are really looking at the efficiencies. And this is why we tokenized our fund, is because if we're asking investors to participate with us, we want to be forward thinking in what we're looking at and what we're doing. And a lot of the investors we're investing in, I have personally invested with prior to the fund. So that was the reason.
Very interesting. So Daniel, you have a family office in Poland and here. Maybe you can talk about sort of the similarities or differences that are going on in the different locations with your investing activities in VC, especially. Are there regulatory differences, and anything that you think that the audience would find interesting?
So I will say that the vast majority of families in Central Europe are interested in predominantly investing in early stage companies in North America. If they do invest in, let's say, a Polish company, the expectation is eventually they come to Silicon Valley. So it is still very much the land of opportunity here. And a big part of my role is actually guiding the investments for the family office in Poland to diversify to North America over the next 3 to 5 years. What I will say is a little bit different that we do is we do focus on impact. From a practical perspective, there's a very small probability of success for early stage companies. And there's very little delta between an experienced manager and an emerging manager if you were to become an LP in a fund. So we actually look for predominantly deep technology companies. And we look for ones that have a mission to somehow materially help the world and have a positive impact. Because even if they waste all their money and fail, our question is, how many people did you positively impact in that journey? So it's not just about ROI for us. And I think that is a major differentiator. I think the other thing is we don't like to be competitive with GPs and VC firms. So 72% of venture capital last year went to B2B SaaS and enterprise. So we don't invest in B2B SaaS and enterprise. There's no reason to compete with VCs. Even funds where we're an LP, we have more of a collaborative relationship. I think that's one of the pivotal changes in the last few years. Over 50% of family offices have made a direct early stage investment last year. That's up tremendously, and that's only growing. So the relationship between GP and family office is changing. It's more collaborative. The expectation isn't that the GP knows everything about the VC space and they have all the deal flow. Now it's more so the family office also brings deals to the table. So we only make 3 or 4 direct investments per year, but there are dozens more that we would love to have a more diversified exposure allocation to through a fund. And that's where our VC partners come in. And that way we can dip our toes in and have a diversified exposure in a fund that invests in 30 to 40 companies rather than putting all our eggs in one basket. So I think the most critical thing for us is having that openness from our VC partners to work collaboratively and finding and deploying investment.
I actually am curious, sort of what percentage of those family offices you're dealing with have wanted to go into VC early stage investments as opposed to other types, because when I had worked for a billionaire family office who wanted to create a consortium of, like-minded, tech-oriented family offices, it was difficult for me to find those partners in Europe because so many of it was old money, and they were very conservative with their investments, and they preferred to keep it in real estate or other areas where there's, very solid cash flow and much less risk, perceived risk anyway. And it sounds like there's been a change now. I'm just curious, is it still primarily just very few people, or you think that it's much more accepted kind of asset class?
That's a really great question.
Yeah.
I think it's important to differentiate Western Europe from Central Europe, particularly if you're a VC or a startup. Poland did not exist 36 years ago. It was under communist rule. It wasn't really a capitalist country until 1989. So there are no G5s. No one was on the Mayflower. There are G1s and G2s that built their fortune through entrepreneurship, and they're still in a growing phase, and they still want to be involved, and they still want to collaborate and build. And I think the most compelling thing is their kids also want to be involved and take over the family business, actively allocate, look for opportunities. So that is the difference between Western Europe, where it's predominantly much older generational wealth. Everything in Poland was built in the last 36 years.
Very good point. Great, so move to Suma. I think you're the only pure VC fund on this panel, but I understand that most of your LPs are all family offices, correct? Maybe you can share with us, their thinking process, like, how you were able to convince them to invest with you, what are their biggest concerns, how they may differ from institutional investors per se.
Yeah, so just some background. So I started the fund in 2020. So AI was still a bit niche, 3 years before ChatGPT came out. And the story was always that this was kind of like an alpha generating vehicle. It was a sector specialization. Most people, unless they're doing exactly what I'm doing, investing in exactly the same types of companies, investing out of the same type of network, they're not getting exposure to it, right? And it was an early point in the whole cycle of like AI. And so the majority of my LPs came from personal relationships that were family office, high net worth investors, or GPs at larger funds. And so that kind of compounded over time over the last 5 years. So I'm basically at about 80% of my LPs are traditional family office, high net worth investors. And then the last 20% I'm getting to now, called an emerging manager fund of funds. And what I've noticed and what I've learned is that every family office is different. And what I had to really kind of understand was what part of my thesis attracted them. And so there's a couple of different buckets, right? So some of the LPs are, you know, always on the lookout for kind of an emerging trend. They found it as a way to generate wealth over time, and they did it for the internet, they did it for the cloud, they did it for mobile, they've done it for biotech. So it's a playbook that they've had. And within that bucket, some of them like to do some directs, some of them like to just have that fund exposure, but it was an easy conversation to have, right? So they knew that, you know, potentially AI was this new thing that was emerging, and through me, they would get access to allocation into this asset class. One of the panels yesterday, the gentleman said that, you know, you should have 3% into venture, right? So when I was starting the fund, I was saying, hey, I think AI is going to be a big theme. You should think about having your portfolio, a certain percentage of that into this. And so that was the story for that bucket. Then if you kind of go into the spectrum of other LPs, there's ones that, like Dan here, have a mix, right? They do direct, indirect, and they like basically the optionality that these funds provide, right? So you get kind of this base case systematic exposure through a fund manager. Hopefully it's a very specific thesis. So in my case, as an example, some of my LPs are, you know, GPs like TPG, bigger funds like Mayfield, family office like Draper. They have a lot of exposure to venture. But what they liked about my approach was that it was very specific in terms of the types of AI companies that I would surface. And then out of 30 that they knew that I would invest in a specific fund, some of them would grow to be outliers. I have one company there, that's this company called Hayden AI, idea that nobody would probably have top-down thought about, but they've done really, really well. They're making smart cities, they're putting computer vision, NVIDIA, GPUs on buses, they're mapping all of these cities. They've gone from 0 revenue in 2020 to 100 million revenue this year. So they're doing great, but through the fund, I negotiate pro rata rights at the early stages. Now those LPs have access to that company, which if they didn't have that contractual agreement through me, it would be really difficult for them to get exposure or allocation into that company. And over time, they've been able to allocate additional capital into that specific idea, which in theory is de-risk relative to my entire portfolio. So for every $1 that an LP invests in my fund, you can think of it as like, you know, I'm a stage specialist, right? I'm a seed stage investor. There's potentially $5 they could put additional capital into a company when they feel it's really breaking out. And that's been kind of my discovery or the epiphany from working with family offices, is that initial fund investment is just a foot in the door for a lot of like the highest quality family offices to work with, because they end up being an extra partner for you in building out this thesis, right? So when you're looking at follow-on opportunities, they're chiming in, they're bringing people from their network, and it really amplifies the value that you bring into the founders. So I think it's a great relationship. I think it's, you know, the whole panel is about how venture capital innovation is going to be fostered by family offices. Because I think if smart fund managers, they're able to adapt, right, and bring the right operating model to their LPs.
Terrific. I guess I'll open this up to the group. Like, you know, what's your view on venture investing, you know, with family offices? Has it changed over the last several years, or has there been, you know, any meaningful differences in the competition for deals? What have you observed?
I think the venture market has changed completely. I think we went through venture winter probably about 4 years ago, where all the venture investments were not getting returned to investors. And so I think the structure of venture transactions, whether they're seed, Series A, or further down the capital raising pipeline, I think that has changed. And I think the technology that's coming out now is really more advanced earlier. And so you're not just raising capital, hey, I have an idea. the transactions that we're looking at, even in the seed and Series A stage, I mean, they're ready for commercializations. They are way far along. And so I think family offices have a huge opportunity into where technology is now and how quickly technology is moving. And I think the venture transactions in these stages, I think it needed to happen. It's really become more venture slash private equity model in a sense, is that you really have to understand the operations, you have to understand the supply chain, you have to understand everything you're building. And when you go to look for capital, you have to really have the technology thought through and really a built product. I mean, that's what we're seeing and that's what we're looking for as we invest.
Actually, to jump on that, like what's, we all know that about 50% you're mentioning family offices invest in direct deals, which increasing tremendously. Some reports showing that almost 80%, depending on one scale. I think Citi is the one who did that research. And the reason is because a lot of big VCs, they cannot produce the returns. There's expectation of unicorn chasing. But another factor, with all the AI coming and a lot of funds using AI to analyze all the data, to analyze the deals, to plug and play. So what happens is that a lot of founders, they know what the data that a lot of VCs are looking for. And when they do their pitch deck, they basically go and click on those data points. So, and they have AI click on those data points. So it basically almost like AI talking to AI. So I think right now more than ever, the human capital is most important, like you were saying about founders, because you cannot still have a company without really human interaction. Who's the team behind it? And with families, we have a lot of power to, first of all, to stay longer if we need it, to provide more capital to support. So we create our own rules, which is we don't follow the GPs, we don't follow the LPs. We don't have a time commitment on that. So I think that by changing that landscape, family offices can really step in and really make a huge difference, because we do have the power to create the rules and to allocate the money and to help those companies who really understand what they're doing, not just focused on the basic AI research.
In fact, I agree to her. I agree to her earliest premise as well. There are two things which got changed in last I can say in last 4 5 years. Number one, that earlier we used to invest only through a VC fund, where we know that a VC fund is going to invest into 30, 40 companies, out of which 2, 3, 4 would be a unicorn, most likely if it's a good VC fund. 50% will get failure, and remaining remaining 30, 40% will have a mediocre returns. So the VC fund return would be close to anything between 24 to 27% CAGR. I have not seen any VC fund across the world till now which has given a CAGR of more than realized CAGR of more than 27%, 28%. So what we learned over a period of time is that let's partner with the VC. First, we used to invest into VC fund. Now we participate in individual deals as well. So we get directly into startup ecosystem. If we like the startup, we invest directly along with the VC. So we become a co-investor with the VC. That approach got changed. One. Number two, 4 years back, we used to ask a question to a founder that what is your business plan? How much sales you're going to do? What are your business projections for the sales? Now we have changed the questions to the founder. We said, what are your plans for profits? How soon you can be in profit? How soon you are going to make bottom line for us and go public, so that we can encash our money. We are not interested in any startup that takes 8 years. Not interested. So we have changed our approach internally so that we can channelize our energy and our money in a better way. And we have changed our internal approach for that. So these are the two changes which we have done, at least in our family office.
So just to add to that briefly, we actually are fairly similar in that way. Lots of similarities, but over 72% of venture capital went to B2B SaaS enterprise last year. So we focus on deep tech. Behind closed doors, some of the conversations that are being had is essentially what is going to be that next defensible market, and is SaaS the new lifestyle business as a result of AI? Because you can build a SaaS company in 5 in a couple months. So I do think the venture industry is changing, and it's going through this transitional period where there is this business model innovation called SaaS, that was invented 15 years ago, that now may or may not be the next best model for venture to focus on. One of the biggest growing roles within a family office is someone with operator experience. Families do not want to be reliant on just their GP partners in evaluating deals. They want to co-invest with a VC, as you were saying. So these are all kind of conversations that are happening, and there isn't really a consensus of what the right decision is. And a lot of that is spurred as a result of AI innovation in the last 3 years, and it's moving so quickly. And notoriously, family offices don't necessarily move as quickly. So it's kind of a mess right now.
Well, another strategy that we implement is working with VCs is we find a really good early stage VCs that has incubators, and they go through 1,000 companies to get, less than 10 into their incubator, and then we build a relationship. So we take the companies that go through that incubator, and then we pick them up from there. So a lot of the work has already been done, and we already know that the founders understand the process that the VCs incubators took them through. So I think that's a really good relationship to have between family offices and VCs.
Just to add a couple of things that I think recaps points made before. So what I notice in my LP base, there's off family groups that obviously are doing it for the returns, right? So in my specific case, with my thesis, it's played out before, it could be big upside. There's also those who have that, but then they also feel it's a way to proactively shape kind of what's happening in a specific sector, and kind of like use their capital to back ideas and back managers like myself. And I don't want to say the word impact, but in some way kind of craft or leave a legacy in a specific space. So like, to talk about specifically with AI, the system you've seen all, I can count how many times we said AI today, but yeah, we're in a moment, right? Whether you think the moment has lasted 3 years, or it's going to keep going for 10 years, it's a really unique time, and a lot of new things are happening. And so if you have this capital as your superpower, what I found is working through other GPs, the families are able to like shape what's happening, how AI is actually being used, and how it's going to influence society. So there's this like bigger mission that I found is kind of hidden through the returns that family offices have been a great partner for.
Okay, great. Appreciate all your contributions there. I guess another one that I'm sure everyone is wondering is, how's the current macroeconomic environment? Like, how are these factors, impacting your investment decisions, when there's a lot of uncertainty, whether it's AI or even geopolitical? How do you go about thinking about that, and how do you think it's impacting your investments?
Well, I mean, for us, that's why we stay in the safety and security area, because it's an expertise we understand and know. And when you stay within your own, level of expertise, then you diminish your risks. In my perspective, also it's finding, a niche or industries that going to survive regardless what situation global is. And obviously, in safety and security increases when there's a lot more uncertainty in the world. But also, always surrounding yourself by people who understand and not thinking that you're the smartest one in the room. I've learned that mistake a long time ago when I was in my 20s. And really being open, like when you go to these conferences is just, the reason we're here is just to share their ideas, to talk to other people, to find out what their perspective is. And that's why we're so blessed to have these conferences where we can talk to our peers in the same environment, in the same room, and find out what are the future trends, what is really going on from the internal perspective, that a lot of other people don't have access to that.
So honestly, for us, I think I know that the world is very fearful of the tweet of President Trump nowadays, and there's a lot of uncertainty around it, that what he's going to tweet tonight. Because I remember there was a joke recently in the media. Earlier, a technical analyst, stock market, used to see the charts. Now he don't see the charts. He see the tweet of President Trump and how the market is going to shape up in the morning. Right? So I think the world has changed in last 1 year. But I think what we are trying to build is we are trying to find out those sectors probably which are recession agnostic. I'll say recession proof. I can say so. So something we are exploring more option in edutech. Where any which ways this sector has an immense potential across the world. So we are trying to find out more companies in edutech and health tech, which will have least impact of any such divergences which keep happening in the world on time-to-time basis. So we're trying to be a recession-proof on that line. We're trying to learn this.
Ah, health tech and ed tech.
Yeah.
People taking notes here.
I just want to talk a little bit about, I mean, first of all, the regulatory environment. I used to finance debt for government agencies. I'm very familiar with the regulatory environment and how it affects investment. I think when we're looking at technologies that are starting to really take shape, like tokenization, like, Larry Fink of BlackRock made the announcement that they're going to tokenize everything. And that would not have been possible last year. That would not have been possible because the regulatory environment did not allow it. Not only did it not allow it, it did not allow banks to make any investments in that regard. They had to hold treasuries, and they were hurt holding treasuries. So I think the regulatory environment definitely affects investment. And I think what's happening with technology and the acceleration of it is happening because some of the regulatory framework is being put in place to allow it to accelerate. That's how we follow what we're interested in investing in. That's why we're investing in operational efficiencies within this frontier tech or, technology that's coming to fruition. But it didn't happen overnight. It's been growing over 5 years. And venture has really changed because over the last regulatory environment that affected venture over the last many years, now they're having a new wave of opportunities to look at technologies without a lot of too much regulatory environment impacting their investment decisions.
Very good point, Jen.
Our case geopolitically, we're very bullish on the United States, and we are reallocating a significant amount of our portfolio to the United States. I think from a technological standpoint, we are asking what's next. AI is, in some ways, as a business, developed very, very quickly. In some ways, exponentially faster than AI as a technology. So it's maturing. That gap is maturing, increasing, and it's maturing differently. So we're asking kind of what is the next multi-trillion-dollar opportunity and seeing if we can get ahead of it, that curve, rather than just focusing on existing frontier technology like AI right now. Some of the things we're looking at is biological augmentation, things of that sort, genomics. But we always ask the question, what is the impact of AI on most early stage companies? And I think from a pragmatic standpoint, it's really that you have to now ask the question, how easily can this be copied? So the barriers to entry for most AI startups, counterintuitively, are decreasing significantly. And that ultimately is not good for business. So now you can build an AI startup in a few weeks. So once you come up with a really good idea, there could be 1,000 copycats within weeks. That's a new age we've never seen before.
Yeah.
You used to have a little bit of a head start, maybe a few months, if a big company came in. So we tend to ask ourselves, how defensive is this company as well?
Yeah, for me, to simplify it, I think I'm very focused on a specific thesis, right, in terms of the types of companies that tend to succeed. And so capital efficiency is part of that. So I used to work at a company before called Cloudflare. Didn't raise a lot of money in the early days, like it was like sub 4 million going into Series A. Worked for 2 other companies that exits, Anaplan, Clearwell. Stayed very disciplined in terms of the early stage capital raise, and then ongoing growth. So the premise around my fund was that capital efficiency with great founders drives like the creation of these big companies that, you know, the exits will be 7 to 9 years from when you first invested. So having that focus and having that thesis, my job as a GP for the family office, I'll leave the bigger questions to them, is I'm going to provide them time diversification on that specific thesis to make sure that that portfolio covers lots of different years, right? So it's a 3 to 4 year vintage. So I've invested in 2020, 2021, 2022, 23. So for each year has been different, but that I've been investing in that thesis in the same way across all the years. So it's very difficult as a GP to try to time macro environments and pacing, et cetera. And it's a lot kind of, these companies take 2 to 3 years to get to the next stage anyways. So I just try to be very an even pace about the deployment of the capital over time, with the assumption that having that systematic view on what really creates the upside over a series of 100 companies, you're gonna get exposure to that. But it's really hard to think about tariffs, this, that, and then like my job is literally find amazing founders that have these huge ideas, arm them with the capital and the network to a sufficient extent so that they can really build these big businesses.
So with so many exciting different technologies and companies out there, how do you guys decide when to double down on an investment versus walking away?
I mean, from my perspective, it's really the founders that I invest in, and so, but it has to be technology at the right time as well, because obviously AI companies now you have a great founder, but again, the technology is not at the right time. There are so many opportunities now with technology that are not necessarily AI. For example, everything's moving to the intelligent edge. And what that means is everything, data is going to be collected wherever it's collected. So you're going to have sensors on train stops, every place you're collecting data there. Everything is moving to the intelligent edge. There's opportunity to invest in Internet of Things and the supply chain relative to that kind of technology. If you look at someone like Elon Musk, every one of his companies, he builds his own supply chain. So the opportunity for technology and investment in technology, there's a lot of opportunities coming today. I mean, very exciting opportunities like tokenization, supply chain, Internet of Things. Things are changing completely on the efficiency side with businesses. And the acceleration is only going to happen quicker and quicker and quicker. And so outside of AI, the opportunity is here. And if it's technology that is one of those that I mentioned and an exceptional founder that has had multiple exits, then I will double down.
No, supply chain is crucial. So in the military drone, everybody's affected by batteries and chips in relation with China. So there's not a lot of, there's a lot of companies who's making US-made drones, but they're so much more expensive. And right now, so to solve the problem to make US-made batteries is actually not as simple, and they're way more expensive. So the question comes, I mean, are we able to actually maybe establish a better relationship with China, or do we need to bring it completely to America? So there's a lot of geopolitical situation also comes into the play. But also, when you doubling down for family offices, especially younger generation, it's not just ROI on the money, it's also what legacy they can create, what good that they can generate. The book I wrote about the true wealth philosophy is, money without purpose is only dollar sign. So for us, it's okay. So finding the companies, how big is the problem you're trying to solve? How many people you can actually impact and increase the quality of their lives? The basics, how long will it take you to go to the market? What are the barriers to enter for other companies? And how affordable this technology is to be applicable to masses. Because if it's great but too expensive, there's really not a way to scale it quickly.
So we will double down only when we feel the founder, what he committed to the business plan to us. He's meeting his number on 6 monthly basis or on a yearly basis, and the founder knows, because everything is subjective. The only thing survives is numbers. If he's meeting his number, what he projected, it seems he's in control of the business. Only in that case, we double down, else we'll exit. Even if we have to cut the loss, we'll cut out. But we are completely trusting the founder and its capability. Macro environment, macro environment, what happened across the world that he has to manage. We are putting in our money, right? So we only double down once he meet the number, what he's committed in the business.
Yeah, when we double down, it's actually pretty clear. We look at the numbers, and when they're growing exponentially, it's kind of a no-brainer. I think the more important question is, what did those founders do differently to actually achieve that exponential growth, profitability, whatever their KPIs are? And I do think there's a number of things. There's the obvious answers, but the less obvious one that we actually collected some data is the companies that have a tendency to statistically, in a level of statistical succeed more, actually have some sort of deeper impact or mission. They're solving some sort of key existential problem. They at least have a good answer of why are we doing this. And we talked to these founders, we've speculated why. And our thesis is that there's a lot of companies and founders at some point to grow need to hire the best talent. And the best people, especially the next generation, Gen Z, if you will, it's really important to them to work on something that they're proud of. And they feel like they're solving a real problem. So that's just something that we've noticed, that these incredible founders, they're building a culture where it's really mission and impact driven, not just about ROI and KPIs.
Yeah, for our fund, I have a very kind of simple model. So there's obviously the reserves that the fund has. So back the founders to get them to that next milestone, which is typically Series A. And then the part that's important for the family office LPs is at what point do we open up that opportunity to co-invest in the follow-on as a double down, and that's has specific metrics. So one is obviously the company's working. So it's almost like a cherry picking opportunity for the LP to get into this company when nobody else could. And then in those situations, there's either the existing larger majority investor is also following on in a big way, or like in the case of Hayden, TPG's Rise Fund came in with a very large position, so a new investment, we have to pro rata. So the decision ends up being pretty clear that, okay, it's working, there's even more capital, quality capital coming in, and that pro rata position ends up being kind of like a great opportunity for the LP base to come in and put additional capital. So try to be kind of very precise about the criteria.
Great. I think we only have 1 minute left. Some of my panelists were interested in finding out who's in the audience. Can we just see a show of hands of how many people here have invested in VC? Okay. Great. Well, maybe more people will be interested after this talk. I guess it's going to be too tough to do one more question given it's only 1 minute, but maybe I'll just open it up to the audience. Does anyone have a question they want to ask the panel? Or anyone specific on the panel? No? Okay.
Thank you.
Well, thank you very much.